The point is made that the regulatory pressure is there. I see it as related to the political risk. John Cunliffe, maybe we should put this to you. How do you see the balance now in the areas of the regulatory pressure on the industry and the political component?
I'd say first that this picture of bank shares going down because of people being concerned about basically how banks will remunerate their shareholders has been going on since probably the middle of last year. So what we've seen in the last few weeks has been a kind of a twist on that, but it's been there for a while. And I think the reason it's pushed down on the sector generally is this question about how banks' business models cope with very low interest rates or even negative rates. So I think there is something in that. But of course, the push down has also been strongest, I think, on the institutions where the perception is they haven't actually found a new business model. And so the first point I'd make on the question is, to put it bluntly, many of the ways in which banks remunerated their equity before the crisis are now prohibited or too expensive. That's not an accident. That's deliberate. I go back to what I said about it being 8 years since the financial bust, and we're still limping out of it. So those are events that you do need to prevent. I do think it's important to try now, when the regulatory reform effort's been going for a while, to give investors in particular a clear picture of what the future looks like. We've tried in the UK actually to do that in December. The Financial Policy Committee came out with a statement on the overall capital framework, which also talked about the average level of capital in the system, taking into account the changes that were likely to come in Basel, and also make clear that in our view we were not looking at another Basel IV, Basel IV, that actually a lot of the work that William has referred to is work that is related to Basel III, which will have distributional effects. I'm not sure I'd agree with him that it will necessarily have the effects. He's saying it depends really on what supervisors have done in different jurisdictions. But I think it is quite important, and the recent turmoil in bank shares, I think, underlines this, for the regulatory community to say, look, the contours of the regulatory reform programme are pretty fixed, the design is done, the numbers are there, we can't give certainty on everything, there is still work going on, but this is the framework, and this is how we see it. That's what we try to do, certainly in the UK. I think there'd be merit, and I think in Basel the governors and heads of supervision tried to do that a bit at the end of the year as well, and I think there will be merit in doing that.
Without trying to go further into the debate of whether we have a Basel IV, Axel Weber, maybe you can pick up the point just on a very high level. Do you see the current regulatory debate as being, is it being a settled issue? Do you now have the visibility that you need for planning and for framing the story that you need to tell to your investors?
Well, maybe 3 points. The first one, fully agree with what John said. If you look at some of the falls in stock markets in general, and in bank stocks in particular, I think there's a mixture of reasons for that. The big picture reason is that, take the US, after 3 years of massive improvements in the stock market, 30% a year, largely fostered by QE, which had the sole purpose of driving investors out of fixed income, low-risk assets into riskier assets that ultimately, because it's equity rather than fixed income, would help finance growth. This worked very well in a period where central banks globally were doing QE. Now that the Fed has tapered and is talking rate hikes, that underlying momentum into equity, the great rotation out of fixed income into equity, is actually reversing. The problem is investors do not rotate back into fixed income to the same degree as they would have done in the past, because fixed income yields are flat and low. And if you start the yield curve in a negative territory, because you mix QE with actually negative interest rates, you can actually have negative yields 10 years out. Look at Switzerland, you pay 35 basis points for the privilege of owning debt of the Swiss state. That is a very unusual fixed income environment. So people are not going out on the risk curve anymore by buying less, sort of more risky assets like equity as opposed to fixed income. They're going out. Our economists talked about the private equity market. They're trying to tie up money for a longer period of time and basically move into more illiquid assets. So one reason why stocks are falling is they lost this central bank support they had in the past. The second one is more idiosyncratic to banks, is there's a huge uncertainty still there about the end regime on regulation. And I think that's why the authorities still need to put into place what Mark Carney talked about, that we're seeing the end of the re-regulation of the banking industry. Some of the things that Bill talked about is actually very, very important in that context. And if you look at, in particular, the new instruments that are being phased in, like CoCos or bail-inable debt, if investors hold these instruments and there is a fear that we're moving again to financial market problems, those instruments are losing value. Investors don't want to hold them, but since they can't sell them at this point in time because they would immediately realize a loss, they're basically taking a hedging strategy, and the way to hedge it is to basically shorten the stock on many of the banks, and therefore you get a downward dynamics in the stock market for banks, and that is feeding into the general mood in the market. So I think we are back in a kind of fragile state. Part of it is still due to the fact that banks are in transition. They're working out their problems over time. Part of it is the regulatory regime is unknown in its endpoint. And part of it is investors are really looking for investment opportunities. And if banks cannot return a return on equity that, with a good margin exceeds their cost of capital, investors will find it increasingly difficult to invest in banks and put money in banks. And that's kind of where we are now. I think we need to move forward from this point in time because we're at a fragile juncture. If investors globally are losing, more and more faith in that banks are investable, I think the current situation could be one that will retain. So differentiation on the business model, moving into more capital-efficient businesses is what is driving some of the strategy debates around banks, and I think this is important to have. But we really need to have the system mapped out with a lot more uncertainty as soon as possible, because we're all needing to work towards that unknown endpoint in transforming our institutions, and it's much better to know what you're actually working towards than trying to second-guess where the regime will end up. And some of the uncertainty that Bill mentioned is very, very important in that context.
Professor Broggi, you spoke before about, would like to ask your reaction to that, because before when you were speaking about the market being concerned with the opacity of banks, do you have sympathy with the fact that the banks maybe see their capital demands being somewhat opaque at this stage?
Well, I think that constant regulatory change has made life difficult for banks. At the same time, I think one of the issues which was not addressed which was not, I think, publicized to the right extent, is the fact that, for example, in the BRRD, we're always talking about bail-inable assets, bail-inable liabilities and things like that, but one of the innovations which I think could or should, to some extent, lower the concerns by the market is the fact that banks have been asked to draw up recovery plans. So in case things do go wrong, they have been working on recovery plans in a very sort of explicit fashion. They've had to actually send those to the authorities. This should even help ultimately resolution if that occurs, so that even though we must preempt any sort of problem with a stronger capital base, the liquidity requirements, etc., and this has put a lot of pressure on banks to sort of comply, and even markets have even sort of asked for immediate compliance to some extent. At the same time, banks have been doing a lot of homework. So they've been thinking about what would happen if there is an idiosyncratic risk regarding the bank, what happens with systemic risk. We've had stress tests. So there has been a lot of activity thinking about what could be done if things do go wrong. And I think that the market should consider this. And another, perhaps a different angle is that, as Commissioner Oettinger was saying this morning, the other concerns, I think, refers to the longer business plan horizon. I think many of us have teenage children. Our children are now called screenagers, and how really, because they're always on their screens, and banks, they're our banks' future customers. And so how are banks dealing with that? And they're dealing with that with lots more technology. And this has transformed many traditional risks into IT risks and cyber risks. So how are banks dealing with that? I think banks haven't really disclosed that to the right extent. And one minor final point is that I think that, as always happens, or often happens in bear markets, not only have stocks gone down, but the volatility has increased tremendously, so like Bill was saying. And so actually now for fund managers who have their budget of risk that they can take on, bank shares have become a much more absorbing factor for risk. So it's more difficult for them to hold more bank shares because other sectors have gone down, but with less fluctuations. So I think these are three elements which bank management should really be thinking about.